What's up, guys? Welcome to day, or I don't know, part 6, part 7 of reading The Big Short. Yeah, I haven't read for like 2 days. Again, apologize. I do apologize. Right, let's get started. 30 minutes of reading. Starting now. The ISDA agreement took months for haggling among lawyers and traders from the big Wall Street firm who would run the market. Burry's lawyer, Steve Duncan, was for some reason allowed to look on the phone calls and even jump in from time to time and offer the Wall Street customers' point of view. Historically, a Wall Street firm worried over the creditworthiness of its customer. Its customer often took it on faith that the casino would be able to pay off its winners. Mike Burry lacked faith. I'm not making a bet against a bond, he said. I'm making a bet against a system. He didn't want to buy flood insurance from Goldman Sachs only to find when the flood came, Goldman Sachs washed away and unable to pay him off. As the value of the insurance contract change says, as flood water approached, but before they actually destroyed the building, he wanted Goldman Sachs and Deutsche Bank to post collateral to reflect the increase in the value of what he owned. On May 19, 2005, and a month before the terms were finalized, Mike Burry did his first subprime mortgage deal. He bought $60 million in credit default swap from Deutsche Bank, $10 million each on 6 different bonds. The reference securities, these were called. You didn't buy insurance on the entire subprime mortgage bond market, but on a particular bond, and Burry had devoted himself to finding exactly the right one to bet against. He had read dozens of prospectus and sourced hundreds more, looking for the dodgiest pool of mortgage, and was still pretty certain even then, and did certain later, that he was the only human being on earth who read them, apart from the lawyers who drafted them. In doing so, he likely also became the only investor to do the sort of old-fashioned bank credit analysis on the home loan that should have been done before they were made. He was the opposite of an old-fashioned banker, however. He was not looking for the best loan to make, but the worst loan, so that he could bet against them. He analyzed the relative importance of the loan-to-value ratio of the home loans, of second liens on the homes, of the location of the homes, and the absence of loan documentation and proof of income of the borrower, and a dozen or so other factors to determine the likelihood that a home loan made in America circa 2005 would go bad. Then he went looking for the bonds backed by the worst of the loan. It surprised him that Deutsche Bank didn't seem to care which bond he picked to bet against. From their point of view, so far as he could tell, all the prime mortgage bonds were the same. The price of insurance was driven not by any independent analysis, but by the rating placed on the bond by the rating agencies, Moody's and the Standard and Poor's. If he wanted to buy insurance on the supposedly riskless AAA rated tranche, he might pay 20 basis point, 0.2%, on the riskier A-rated tranches. He might pay 50 basis point, 0.5%, and on the even less safe BBB rated tranches, 200 basis points. That is 2%. A basis point is 100 of a percent point. A BBB rated tranches, the one that would be worth 0 if underlying mortgage pool experienced a loss of just 7%, were what he was after. He felt this to be a very conservative bet, which he was able, through analysis, to turn into even more of a sure thing. Anyone who even glanced at the prospectus could see that there was many critical differences between one BBB bond and the next. The percentage of the interest only loan contained in their underlying pool of mortgages, for example. He set out to cherry pick the absolute worst ones and was a bit worried that the investment banks would cut on to just how much he knew about specific mortgage bond and adjust their price. Once again, he shocked. Once again, they shocked and delighted him. Goldman Sachs emailed him a great long list of crappy mortgage bonds to choose from. This was shocking to me, actually, he says. They were all priced according to the lowest rating from one of the big three rating agencies. He could pick from the list without alerting them to the depth of his knowledge. It was as if you could buy flood insurance on the house in the valley for the same price as a flood insurance on the house on the mountaintop. The market made no sense, but that didn't stop others Wall Street firms to jump into it, in part because Mayberry was pestering them. For weeks, he hounded Banks of America until they agreed to sell him $5 million in credit default swap. 20 minutes after they sent their email confirming the trade, they received another back from Berry. So can we do another? In a few weeks, Mayberry bought several $100 million in credit default swap from half a dozen banks in chunk of $5 million. None of the sellers appeared to care very much which bond they were insuring. He found one mortgage pool that was 100% floating rate negative amortizing mortgages, where the borrowers could choose the option of not paying any interest at all and simply accumulate a bigger and bigger debt until presumably they default on it. Goldman Sachs not only sold him insurance on the pool but sent him a little note congratulating him on being the first person on Wall Street or off ever to buy insurance on that particular item. I am educating the experts here, Berry crowd in an email. He wasn't wasting a lot of time worrying about why these supposedly shrewd investment bankers were willing to sell him insurance so cheaply. He was worried that others would caught on and the opportunity would vanish. I would play dumb quite a bit, he says, making it seem to them like I don't really know what I'm doing. How do you do this again? Oh, where can I find that information? Or really? One, they tell me something really obvious. It was one of the fringe benefit of living for so many years, essentially alienated from the world around him. He could easily believe that he was right and the world was wrong. The more Wall Street firms jumped into the new business, the easier it became for him to place his bet. For the first few months, he was able to short at most $10 million at a time. Then in late June 2005, he had a call from someone at Goldman Sachs asking him if he'd like to increase his trade size to $100 million a pop. What needs to be remembered here, he wrote the next day after he had done it, is that this is $100 million. That's an insane amount of money, and it just gets thrown around like it's 3 digits instead of 9. By the end of July, he owned credit default swap on $750 million in subprime mortgage bond and was privately bragging about it. I believe no other hedge fund on the planet has this sort of investment. Nowhere near this degree, relative to the size of the portfolio. He wrote to one of his investors who had caught wind that his hedge fund manager had some new fund strategy. Now he couldn't help but wonder who exactly was on the other side of his trade. What man-made would be selling him so much insurance on bond he had handpicked to explode? The credit default swap was a zero-sum game. If Mayberry made $100 million when the subprime mortgage bond he had handpicked defaulted, someone else must have lost $100 million. Goldman Sachs made it clear that the ultimate seller wasn't Goldman Sachs. Goldman Sachs was simply standing between insurance buyer and insurance seller and taking a cut. The willingness of whoever this person was to sell him such vast amount of cheap insurance gave Mayberry another idea, to start a fund that did nothing but buy insurance on subprime mortgage bond. In a $600 million fund that was meant to be picking stocks, his bet was already gargantuan. But if he could raise the money explicitly for this new purpose, he could do many billions more. In August, He wrote a proposal for a fund he called Milton's Opus and sent it out to his investor. The first question was always, was Milton Opus? Here's a Paradise Lost. But that usually just raised another question. Most of them still had no idea that their champion stock picker had become so diverted by these as esoteric insurance contract called credit default swap. Many wanted nothing to do with it. A few wondered if this meant that he was already doing this sort of thing with their money. Instead of raising more money to buy credit default swap on subprime mortgage bond, he wound up making it more difficult to keep the one he already owned. His investors were happy to let him pick stocks on their behalf, but they almost universally doubt his ability to foresee big macroeconomic trends. And they certainly didn't see why he should have any special insight into the multi-trillion-dollar subprime mortgage bond market. Milton's Opus died a quick death. In October 2005, in his letter to investor, Burry finally came completely clean and let them know that they own at least $1 billion in credit default swap on subprime mortgage bond, sometimes market big time, he wrote. Market when they gave America outlined the currency to buy Time Warner. They erred when they bet against George Soros and for the British pound, and they are erring right now by continuing to flood along as if the most significant credit bubble history has ever seen does not exist. Opportunities are rare, and large opportunities on which one can put nearly unlimited capital to work at tremendous potential return are even more rare. Selectively shorting the most problematic mortgage-backed security in history today amount to just such an opportunity. In the second quarter of 2005, credit card delinquencies hit an all-time high, even though house prices had bombed. That is, even with this asset to borrow against, Americans can struggling more than ever to meet their obligations. The Federal Reserve had raised interest rate, but mortgage rate was still effectively falling because Wall Street was finding ever more clever way to enable people to borrow money. Burry now had more than $1 billion but on the table and couldn't grow it much more unless he attract a lot more money. So he just laid it out for his investors. The US mortgage bond market was huge, bigger than the market for the US Treasury note and bonds. The entire economy was premised on its stability, and its stability in turn depended on how prices continuing to rise. It is ludicrous to believe that asset bubble can only be recognized in hindsight, he wrote. There are specific identifiers that are entirely recognizable during the bubble inflation. One hallmark of mania is the rapid rise in the incidence and complexities of fraud. The FBI report mortgage-related fraud is up fivefold since 2000. Bad behavior was no longer on the fringe of an otherwise sound economy. It was its central feature. The salient point about the modern vintage of housing-related fraud is its integral place within our nation's institution, he added. This wasn't all that different from what he'd been saying in his quarterly letter to his investors for the past 2 years. Back in July 2003, he had written them a long essay on the causes and consequences of what he took to be likely housing crash. Alan Greenspan assured us that home prices are not prone to bubble or major deflation on any national scale, he said. This is ridiculous, of course. In 1933, during the fourth year of the Great Depression, the United States found itself in the midst of a housing crisis that put housing starts at 10% of the level in 1925. Roughly half of all mortgages debt was in default. During the 1930s, housing prices collapsed nationwide by roughly 80%. He hoped on the same theme again in January 2004 and then again in January 2005. Want to borrow $1 million for just $25 a month? Quicken Loans has now introduced an interest-only adjustable rate amount that gives borrowers 6 months with both zero payment and a 0.03% interest rate. No doubt in support of that wholesome slice of Americana, the home buyer with the short-term cash flow problem. When his investor learned that their money manager had actually put their money directly where his mouth had long been, they were not exactly pleased. As one investor put it, Mike's the best stock picker anyone knows. And he's doing what? Some were upset that a guy that they had hired to pick stocks had gone off to pick rotten mortgage bonds instead. Some wonder if credit default swaps were such a great deal, why Goldman Sachs would be selling them. Some question the wisdom of trying to call the top of 70-year housing cycle. Some didn't really understand exactly what a credit default swap was and how it worked. It has been my experience that apocalyptic forecasts on the US financial market are rarely realized within limited horizon. One was thorough to bury. There have been legitimate apocalyptic cases to be made on US financial market during most of my career. They usually have not been realized. Barry replied that while it was true that he forecast Armageddon, he wasn't betting on it. That was the beauty of credit default swap. They enable him to make a fortune if just a tiny fraction of these doubles pool of mortgage went bad. Inadvertently, he opened up a debate with his own investors, which he counted among his least favorite activities. I hated discussing idea with investors, he says, because I then become a defender of the idea and that influences your thought process. Once you become an ideas defender, you had a harder time changing your mind about it. He had no choice. Among the people who gave him money there was pretty obvious a built-in skepticism of so-called macro thinking. They could understand why this very bright young rooting around in financial statement might stumble across a small company no one else was paying attention to. They couldn't see why he should have a deeper understanding of trends and global focuses apparent to any American who flipped on a cable news program. I have heard that White Mountain would rather I stick to my knitting, he wrote testily to his original backer. Though it is not clear to me that White Mountain has historically understood what my knitting really is. No one seemed able to see what was so plain to him. These credit default swaps were all part of his global search for value. I don't take breaks in my search for value, he wrote to White Mountain. There is no golf or other hobby to distract me. Seeing value is what I do. When he had started Scone, he told potential investors that because he was in the business of making unfashionable bets, they should evaluate him over the long term. Says 5 years. Now he was being evaluated moment to moment. Early on, people invested in me because of my letters, he said. And then somehow after they invested, they stopped reading them. His fantastic success attracted a lot of new investors, but they were less interested in the spirit of his enterprise than how much money he could make them quickly. Every quarter, he told them how much he had made or lost from his stock picks. Now he had to explain that they had to subtract from that number these subprime mortgage bond insurance premiums. One of his New York investors called and said ominously, you know, a lot of people are talking about withdrawing funds from you. As the funds were contractually stuck in Scone capital for some time, the investors' only recourse was to send him disturbed sounding email asking him to justify his new strategy. People get hung up on the difference between plus 5% and negative 5% for a couple of years. Burry replied to one investor who had protested the new strategy. When the real issue is over 10 years, who does 10% basis point better annually? And I firmly believe that to achieve that advantage on an annual basis, I have to be able to look out past the next couple of years. I have to be steadfast in the face of popular discontent, if that's what the fundamentals tell me. In the 5 years since he had started, the S&P 500 against which he was measured was down 6.84%. In the same period, he reminded his investor Scout Capital was up 242%. He assumed he had earned the rope to hang himself. He assumed wrong. I'm building breathtaking sand castle, he wrote, but nothing stopped the tide from coming and coming and coming. Oddly, as Mike Burry's investor grew restive, his Wall Street counterparties took a new and envious interest in what he was up to. In late October 2005, a supreme trader at Goldman Sachs called to ask him why he was buying credit default swap on such very specific tranches of subprime mortgage bonds. The trader let it slip that a number of hedge funds had been calling Goldman Sachs to ask how to do the short housing trade that Scout is doing. Among those asking about it were people Burry had solicited for Milton's opus. People had initially expressed great interest. These people, by and large, did not know anything about how to do the trade and expect Goldman to help them replicate it. Burry wrote in an email to his CFO, "My suspicion is Goldman helped them, though they denied it." If nothing else, he now understood why he couldn't raise money for Milton Opus. If I describe it enough, it sounds compelling, and people think they can do it for themselves. He wrote to an email confident. If I don't describe it enough, it sounds scary and binary, and I can't raise the capital. He had no talent for selling. Now the subprime mortgage bond market appeared to be unraveling. Out of the blue, on November 4, Burry had an email from the head subprime guy at Deutsche Bank, a fellow named Greg Lipman. As it happened, Deutsche Bank had broken off relation with Mike Burry back in June after Burry had been, in Deutsche Bank's view, overly aggressive in his demand for collateral. Now this guy calls and says he'd like to buy back his original 6 credit default swap Scout had bought in May. As a $60 million represent a tiny slice of Burry's portfolio, and as he didn't want any more to do with Deutsche Bank than Deutsche Bank wanted to do with him, he sold them back at a profit. Greg Lipman wrote back hastily and ungrammatically, "Would you like to give us some other bonds that we can tell you what we will pay you?" Greg Lipman of Deutsche Bank wanted to buy his $1 billion in credit default swaps. "Thank you for the look, Greg," Burry replied. "We are good for now." He signed off thinking, how strange. I haven't dealt with Deutsche Bank in 5 months. How does Greg Lipman even know I own this giant pile of credit default swap? 3 days later, he heard from Goldman Sachs. His saleswoman, Veronica Greenstein, called him on her cell phone, which is what she did when she talked to without being recorded. Wall Street firms now recorded all calls made from their trading desk. "I'd like a special favor," she asked. She too wanted to buy some of his credit default swap. "Management is concerned," she said. "They thought the traders had sold all this insurance without having any place they could go to buy it back. Could Mike Burry sell them $25 million of the stuff at really generous price on the subprime mortgage bond of his choosing, just to pleasant Goldman management? You understand?" Hanging up, he pinched Bank of America on a hunch to see if they would sell him more. They wouldn't. They too were looking to buy. Next came Morgan Stanley. Again, out of the blue. He hadn't done much business with Morgan Stanley, but evidently Morgan Stanley too wanted to buy whatever he had. He didn't know exactly why all these banks were suddenly so keen to buy insurance on subprime mortgage bonds, but there was one obvious reason. The loans suddenly were going bad at an alarming rate. Back in May, Mike Burry was betting on his theory of human behavior. The loans were structured to go bad. Now in November, they were actually going bad. The next morning, Burry opened the Wall Street Journal to find an article explaining how the new wave of adjustable rate mortgages were defaulting. In their first 9 months, at rates never before seen, lower middle class America was tapped out. There was even a little chart to show readers who didn't have time to read the article. He thought, the cat's out of the bag, the world's about to change. Lenders will raise their standards, rating agencies will take a closer look, and no dealers in their right mind will sell insurance on subprime mortgage bond at anything like the price they have been selling it. I'm thinking in the light bulb is going to pop on and start, and some smart credit officer is going to say, get out of these trades. He said, most Wall Street traders were about to lose a lot of money, with perhaps one exception. Mike Burry had just received another email from one of his own investors that suggested that Deutsche Bank might have been influenced by his one-eye view of the financial market. Greg Lippmann, the head subprime mortgage trader at Deutsche Bank, was in here the other day, it read. He told us that he was short $1 billion of this stuff and was going to make ocean of money or something to that effect. His exuberance was a little scary. How can a guy who can't speak English lie? By the time Greg Lippmann turned up in the Front Point conference room in February 2006, Steve Eastman knew enough about the bond market to be wary, and Winston Daniel knew enough to have decided that no one in it could ever be trusted. An investor who went from the stock market to the bond market was like a small, furry creature raised on an island without predators, removed to a pit full of pythons. It was possible to get ripped off by the big Wall Street firms in the stock market, but you really had to work at it. The entire market traded on screens, so you always had a clear view of the price of the stock of any given company. The stock market was not only transparent but heavily policed. You couldn't expect a Wall Street trader to share with you his every negative thought about public companies, but you could expect he wouldn't work very hard to sucker you with outright lies or blatantly use inside information to trade against you, mainly because there was at least a chance he'd be caught if he did. The presence of millions of small investors had politicized the stock market. It had been legislated and regulated to at least seem fair. The bond market, because it consists mainly of big institutional investors, experienced no similarly populist political pressure. Even it came to dwarf the stock market. The bond market eludes serious regulation. Bond salesmen could say and do anything without fear that they'll be reported to some authority. Bond traders could exploit inside information without worrying that they would be caught. Bond technicians could dream up even more complicated security without worrying too much about government regulation. One reason why so many derivatives had been derived one way or another from bond. The bigger, more liquid end of bond market, the market for US Treasury bonds, for example, traded on screen. But in many cases, the only way to determine if the price some bond trader had given you was even close to fair was to call around and hope to find some other bond trader making a market in that particular obscure security. The opacity and complexity of the bond market was for big Wall Street firm a huge advantage. The bond market customer lived in perpetual fear of what he didn't know. If Wall Street bond department were increasing the source of Wall Street profit, it was in part because of this. In the bond market, it was still possible to make huge sums of money from the fear and ignorance of customers. And so it was no particular reflection on Greg Lippmann that upon entering Steve Eastman's office, he collided with a wall of suspicion. Moses could have walked in the door, and if he said he came from fixed income, Bonnie wouldn't have trusted him, said Eastman. That's enough for today. Okay. Right. That was 30 minutes of reading The Big Short. That was pretty interesting. Hope you understand what I read, and I hope I'll get better over time. So, yeah, I'll see you in the next episode, man. Bye.